With the final blessing from Jerome Powell on Wednesday, the bears have finally come out to play, and there's two major reasons as to why this market crash, so to speak, can continue here. So let's dive into both of those reasons and build out a game plan based on logic to help navigate the coming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got two additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, we've got ourselves a solid red-bodied bar, just a little bit of an upper wick, nothing to read into from a psychological perspective. If anything, just sellers stepping up at the highs of the range. But of course, the most noteworthy part is the sellers closing extremely weak at the bottom of the range here. So sellers upper hand from a structural perspective if we think about location on the bar-to-bar count lower high and a substantial lower low. Sellers go 2 for 2 on the weekly here. What else can we say? This, of course, is a double inside bar setup. We talked about how rare that was last week. We've broken down from that setup. We've closed not only underneath the container bar low, but also underneath the last higher low in the overall trend sequence. And this is extremely important from a trend perspective because from here to here, we had already seen a weekly lower high. You could have considered this a weekly lower high double top. And now that we've broken down and closed underneath that neckline, we of course have brought in a lower low. So officially, we are in a weekly downtrend, and that's substantial because we have not seen a weekly downtrend ever since the October low, right? It's been higher low, higher low, higher low, soft low, higher low, and along the way complementing every single one of these pullbacks with a next higher high in the overall sequence. So now that this has changed and we're in a weekly downtrend, that's one of the major reasons. A higher time frame trend change is one of the major reasons as to why the market pullback, market crash, as we dubbed it in the intro, can continue lower. What would the overall target be if we scrunch this out? Remember that this is the neckline of your monthly inverted head and shoulders. That would look something like this, right? We could also consider it a weekly ascending triangle on the second portion. We have thin structure as we broke to make this leg higher. So overall, retracing this does not really strike me as being all that difficult now that we're officially in a weekly downtrend. Notice that that level is 420. We've talked about that level for quite a bit over the past couple of trading months, really. And it would also align nicely with, if it happens over time, our weekly 50 SMA for confluence of support. That's if we move lower first, right? So looking for 420 as a target. What if we move higher? Well, let's not forget that once again, we just produced a brand new lower low. We really don't want to be chasing lower lows in terms of getting involved from a risk reward perspective, and we'll see another reason for that in just a moment. But even if the market does move higher here, is it not logical that after a lower low, we could be searching for some sort of lower high on the weekly time frame chart to keep us in an overall downtrend? Just as a weekly note, we could technically come all the way for a back test of the double inside bar breakdown and still be producing some sort of weekly lower high, right from here to something in here. And lo and behold, remember also that this level has been the quote breaking point for our market, and we finally broke. Right, that back test could produce a weekly lower high. So things do make sense here on the higher time frame for further downside as we walk forward. Let's go ahead and take a look at our anchored view apps. Any confluence of support over here? The answer is yes. We have broken down underneath the AI Mania anchored view app. However, we're coming into this anchored view app from the bottom of this as an overall move. And if you've been following the channel for the past couple of weeks now, you basically know that if we come in with the Fibonacci's as well from the low up to the high, we'll start with this move, right? The 38.2 is right there. So confluence of support, once again, breaking to a lower low, coming into a 38.2, an anchored view app. Do you want to be a new money weekly short at this area of potential support? I would argue no. But as we just walked through, even if we do get some sort of rally here, a back test of the breakdown from the double inside bars would produce a weekly lower high, keeping us in an overall weekly downtrend. So it's bearish no matter how you slice the cake. We can provide more confluence around that 38.2 if we come in for something that does this to this. Oops, sorry. We want to come in from here. There we go. To here. That's what we want. There's your confluence with the 61.8, the retracement from all-time high to the October low. And then lastly, from the AI Mania to the top. This one's interesting because also your 38.2 here, remember that your 61.8, 38.2, this is the 430 level, right? But your 38.2 from here is the back test. It is the possible lower high on the weekly, confluence with the AI Mania anchored view app, and the retest of the double inside bar lows, right? So everything's making sense here that there is the possibility for a counter trend move to see a lower high set on the weekly, and then possibly looking for shorts here if we can pick off the structure on a daily chart, or the equal low breakdown through after a lower high has been set. What does the volume profile have to say about all of this? I would argue that it aligns with this thesis thus far, because if we take a look, let's zoom in a little bit on this, something that does that. This high volume node is the breaking point. It's the bottom of the double inside bar setup that we just broke down from. Because we're underneath it, obviously it has the opportunity to act as resistance now, producing once again your weekly lower high. That's if we rally first. If we get straight up continuation, that's fine, because we know that we're in a low volume void. The next high volume node really comes in closer to that monthly retest of the inverted head and shoulders neckline, the ascending triangle breakout point right here through the thin structure. That's the low volume void, right? To retest the high volume node at 420. So no matter how you slice the cake here on the higher time frames, things are looking more bearish than bullish, and that's one of the major reasons as to why this breakdown, in my eyes, has more of a substantial threat than any of the pullbacks that we've seen prior. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 438.50 roughly, and that of course would imply a big time lower high. If we're contained by the lower bound, the number is 422 flat, and that of course is a big time lower low. So obviously the expected move here is definitively more bearish than bullish, but what I find most interesting is the opportunity, or suggestion rather, that there's the possibility of a gap fill reversal to offer up a daily lower high, tagging the upper bound of the expected move. Once again, 438.50. And speaking of lower highs, what's the daily trend here? Well, on the weekly time frame chart, we just talked about how this to this is a weekly lower high, and this to this is a weekly lower low. So weekly downtrend, daily downtrend, absolutely. High, lower high, lower high. And along the way, we of course have low, lower low, and lower low. So definitely in a daily downtrend, and also sitting on the lower low currently as of Friday's close. And once again, what does that mean? Well, number one, we probably don't want to be chasing the lower low because the risk reward profile is not as favorable there. But more importantly, it means that even if we do see a rally, it's a counter trend rally in the context of a downtrend now, and we're searching for a lower high. As we were just mentioning, your perfect daily lower high is here, somewhere around the gap fill reversal, 438.50, excuse me. But even if we go beyond that, is it not reasonable that we could also set a lower high underneath 433.25? And just as a reminder, if I continue this off to the left, this has been the breaking point that we've talked about in the market for the past couple of weeks now. But more importantly from that, it's the double inside bar lows where the breakdown came from on the weekly time frame chart, right? So that's the back test we were just talking about for a weekly lower high once again. And even beyond that, a daily double top is in play, and that's the neckline of your double top. So a back test of the neckline there is also more bearish than bullish. So as long as we're underneath 443.25, nothing really changes about this daily time frame chart. What other bearish context do we have here on the SPY daily? Of course, this, as a head and shoulders, has now broken down underneath the neckline with the close on Thursday and Friday below, and there's absolutely no attempt from the buyers to close the gap on Thursday morning's open. So yeah, anybody can look at this chart and of course say, yeah, there's a bearish breakdown taking place, but how bearish is it? Well, stack up a double top, stack up a neckline of a head and shoulders breaking down, no gap fill attempt on Thursday. It's definitively more bearish than just your average breakdown out there in the market. Now, what if we continue lower right out of the gates early on in this coming week's worth of trade? Once again, it's very difficult to be a new money short at a lower low and shorting into potential areas of support. I want you to really focus on this level right here at 426.50, because if we take out the trend lines and we start to perform a little bit of trend line analysis here, and we come all the way from the October low, there's your anchor. This, as a secondary trend line, has broken down. That, of course, was bearish on the FOMC from Wednesday. But look at the confluence at this point right here. If this overall is going to be considered a monthly bull flag or something of that nature, then we need to support off the bottom end of the major trend channel, but also the counter trend, monthly counter trend, red channel that we see on the chart in front of us here. And lo and behold, if we extend the lows of that flag range we were just talking about with our horizontal levels, you get massive confluence of support around that 426.50. So if the market does continue to stretch like a rubber band early on in the coming week's worth of trade, early on, right? We're talking about 426.50 potentially providing the launching pad for a counter trend. Again, let me be very clear about that. It's a counter trend move. We're not expecting a massive daily trend reversal. This is a counter trend move in the context of an existing, now daily downtrend here, but this is an extremely interesting area of potential support. The other thing I want to do is just quickly throw on the clean set, and we will bring up our anchored view apps from all of the major inflection points since the October bottom. And the main reason I'm bringing this chart up is because you can clearly see two different cohorts of buyers. You have the upper and the lower cohorts based on these anchored VWAPs as let's just call them a ribbon, so to speak, right? Everything prior to the AI mania and everything after the AI mania. Everything after the AI mania is suggesting that, okay, all these buyers are now coming underwater, so to speak, whereas the longer time frame buyers who are initiating, early in 2023, late 2022, those buyers might technically be okay. And once again, where is their confluence instantly if we continue to stretch the rubber band lower? It's at the top of the ribbon of anchored VWAPs here around that 426.50 early on in the coming weeks worth of trade. So is it reasonable that something that does this then sees some snapback? I would argue yes, based on what we can see here on the daily time frame chart. Let's move on down to an hourly time frame chart now, get a little bit more granular and continue to tell ourselves the story of what's ultimately been unfolding over here. Remember that on Wednesday, we technically gap up and over our Tuesday reversal bar. Very strong reversal here. There's technically a gap fill reversal early on Wednesday's session. FOMC is the nail in the coffin, and we close extremely weak underneath the daily hammer low back down over here. No gap fill reversal. And the other thing to point out, which adds strength to the sell side of the market here, is if we expand the hourly time frame chart, we talked about this in the pre-market preps, we technically had a spike into the Thursday afternoon close. And on Friday morning, we moved up and over the top of the spike. So in theory, shorts should have, again, in theory, quote, should have closed out some of their shorts because anyone who initiated down here is now underwater on the short side of the market. We never got the squeeze. So if the buyers are not doing their job up and over that key level, which would have been 433.65, and then we rotate back lower, it further builds the case that yes, stronger sellers are certainly here in this market. Now, don't get me started about the close of Friday. That was absolute mayhem. It was up, it was down, it was back up, down. Craziness, but obviously we closed at the lower low. So what does that really set us up for into the coming weeks worth of trade? Let's start by looking at the anchored VWAPs from all the major breakout points on the hourly. So we're coming from the top, the lower high on the daily, and then the FOMC day here. Obviously, nothing changes on the bull side of the market until we can clearly, well, we talked about this on the higher time frames, get up and over the very last anchored VWAP that's coming from here, right? That requires a move over 443.25, big stretch of the imagination, not a high probability outcome into the coming weeks worth of trades. So, okay, if that's not really going to work out, where's the next one? That's here at 440.50. Is there the opportunity for a lower high there? Absolutely, but more importantly, as the week continues to wear on, like imagine how this continues to drift lower, right? You're getting major confluence at the potential gap close and upper bound of this week's expected move. How do we get there for a counter trend style rally? Again, counter trend, do not overstay your welcome on the long side of this market. Obviously, everything that we've seen stacks up as a bearish data point. If we're consolidating down here, bears remain firmly in control. We're likely just getting hourly bear flag consolidation, and over time, we will look for an equal low breakdown. If we get some sort of move for a higher low over 433.65, that's where I would look for this gap to potentially be on the table as something that can close. That's over 436, looking for the closure at 438.50, and then a gap fill reversal off of that area. Remember, on the daily time frame chart, we're ultimately looking for a daily lower high here. If we do continue through this, right, let's just say that we do this, remember that you are looking for a weekly lower high up here. So it doesn't matter how you slice the cake, we're still maintaining a more bearish edge overall, but you can see a counter trend move if you start clearing some of these major hurdles, right? But this is still a primary thesis, weekly lower high, daily lower high here. If we get the consolidation, again, breakdowns underneath 429.25, looking for 426.50. If we just get straight shot lower early on like Monday or Tuesday session into 426.50, we built the case based on the trend lines that this is probably not a short into this area. You are looking for a snapback move. If this has to happen first, then what you're looking for down here is some sort of hourly hammer, some sort of 5 or 15 minute double bottom, inverted head and shoulders, whatever, something down here that offers a clear risk reward setup. You are retargeting the breakdown point here. Make sure that this risk reward is at least a 2-to-1, and then maybe you can look for continuation into this area here, but I would not have any major expectations that this resolves in anything higher. If we have to come here first and we're looking for the oversold reaction off of 426.50, that really sets up the move for just chop through here on any sort of re-entry over the move, right? So the downside path, let me clear this up and we'll talk about downside path only, right? If we extend get some sort of, inverted head and shoulders down here, you could trade this long, but as we approach this area, I would keep very, very mild expectations of what the market can potentially do in the upward direction, right? It just would not make sense. You're really looking for a lower high. Ideally, it would be there. That's what the bears would want to see, or some sort of retest over here. Just no attempt up and over the spike base, or top, I should say, from the Thursday session, 433.65. So a very bearish market here. However, there is the opportunity to set a lower high. I would probably side with, if I had to rank order what I'm looking for, probably side with this to break down, this, and then counter trend to here. I would really put these as a back burner situation, something that really, really does this. That's a much lower tier situation to be thinking about based on all of the evidence that we're about to walk through. Exhibit A is always the market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, does this screen align with or contradict the bearish thesis that we've come up with thus far? Clearly, on the Thursday session, you can see nasty volume outflows to follow up from our FOMC breakdown and add on to the gap down. In terms of net volume flows on the week, we close out at negative 840 million. Remember that the substantial threshold is positive or negative 500 million. So very substantial outflows in this last week's worth of trade. In terms of the advanced decline line on Thursday's major breakdown, yes, we did see complete trend lower zone. On Wednesday's breakdown during the FOMC, we moved to and through the zero line. And we'll talk about Friday in just a moment. Friday is the only perplexing day. And I mean, look at the cumulative build on Thursday. This speaks for itself. This might be one of the worst cumulative builds that I've ever seen, negative 8,000 roughly into the close there. So what was going on Friday, which is fairly interesting? Friday morning, if you were watching, the internals actually opened up on the bull side of the market, and I can illustrate this over here. If we just throw up something like a 5-minute time frame chart, what I want to point out is the breadth specifically early on Friday, right? If you take a look at where we're at over here, 3.5 roughly on the open, 3.5 on the bull side of the market. Obviously, it fades throughout the duration of the day, but if Friday was going to produce that move up and over the top of the spike, all of the ingredients were there. Technically, we had bullish breaths on the open. If we take a look at the advanced decline line, it opens higher in the overall zone, right? And the ticks as well open up positive around 800. So the fact that we never actually squeezed any of the shorts up and over this area in here would speak to the buyers had their shot, they completely failed. Who does that give the upper hand to? Obviously, the sellers. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Does this agree with or disagree with the bearish analysis thus far? This is actually a counterpoint, right? Because you'll notice that the value area and point of control from Thursday are higher in the overall profile, as are they in the Friday session. Value area and point of control are higher in the overall session. We did technically breach the bottom over here, and we did produce yet again another spike in M period. So it'll be very interesting early on potentially Monday session on the open there, whether or not we open inside of Friday's range. And if so, classically, spike rules would tell us that these lower prices are being rejected. Shorts from in here should squeeze, and we'll look for a rotation probably closer to that point of control, because this is a mechanical level right around and at the spot of the spike high from the Thursday afternoon breakdown. And we remember that level as 43.90. That would be an upper target potentially early on Monday if we can open above the spike from Friday's session, and that level is closer to 43.64. 43.64. If we open over 43.64, this would be the sort of look that we're going for. And again, that would be a counter trend rally in the face of an existing downtrend. But you can clearly see, again, if the sellers truly were so strong, why was there no volume commitment at the lows? As soon as we get a flip of where price action starts trading, obviously when we're underneath value area, it's breakaway to the downside. Let's be clear about that. But if we can start to get above this value area, then what does that sort of imply? Anybody who was a new money short, where the majority of them actually transacted, start to become underwater, and it furthers the opportunity for a counter trend rally. So market profile is actually counter to the analysis that we've seen thus far over in the candle analysis, as well as our market internals analysis. Also, from an excess perspective, this is great excess at the lows. This is the proper end of the auction. We don't have a poor high. So if this is truly going to mark the bottom, there's no issue with a poor low needing repair at the end. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLV, although we had full-blown correlation to the downside, right? The XLV is at the top of the list by being down the least. That's at 1.3% in the downward direction, and as we know, that's classically more deferred defensive in terms of sector posture. Same thing with the utility sector, the most defensive sector, only, air quotes, down 1.82%. At the bottom of the barrel, this is where the damage is really done. Look at your XLY, consumer discretionary, classically a risk-on style sector, down 5.89%. Just an absolute bloodbath out there. Let's take a look at the structural charts. So slight defensive posturing, but full-blown correlation to the downside, right? If we look at the structural charts, XLV, it's not really all that bad yet. Remember that under 129, we start to become much more concerned. Obviously, this is overhead supply. Any consolidation in here is definitively bearish consolidation, no doubt about that. And the red inverted hammer from Friday might suggest that we do continue to see some downside here. This is not helpful to the bull case over in the S&P as a whole. XLU, what do we see over here? Possibility for some sort of really sloppy inverted head and shoulders. There's still the opportunity here for a daily higher low as well. Ideally, in a picture perfect world, it would have been here around 64. No dice on that move, but still seeing the slight outperformance by not being down as bad is a defensive look in my eyes. The fact that utilities did not break to a new lower low, whereas we're about to see the XLK is sitting right there on the lower low. Not really a great look, right? So if we're looking for a risk-on move, a big, strong reversal out of the daily time frame chart on the SPY, this is not it from a sector posture perspective. We have an inside bar on Friday out of the XLK, inverted hammers back-to-back, both of them suggesting no buyers showing up at the gap close, instead just a gap fill reversal. So obviously the threat here is a new lower low underneath 163.25 is a new weekly lower low, and the pain continues for our broad market. Even if we do get some sort of rally, there's a clear opportunity for some sort of weekly or even daily lower high anywhere underneath that 170.25 mark. Next up, we've got the XLP. What's going on with consumer staples falling off of a cliff over here? This is D for defensive, so it doesn't need to be the first one to turn if the market is going to make a strong reversal. If anything, this just weighs in on the bearish nature of what's going on overall. Even the defensive names cannot catch a bid, and when you have full-blown correlation to the downside, obviously it's a recipe for disaster in the broad market as a whole. XLC, what's going on over here? Not quite on the equal low like our XLK, but we do have back-to-back inverted hammers, both suggesting gap fill reversals, and the bears remaining in control. Anything that keeps price underneath 66.75 is bearish pressure for our S&P, noting that this is overhead supply, looking for a lower high to be set, or just continuation underneath the equal lows here. Technically, Friday is actually a bearish engulfer, making a higher high on the bar-to-bar count and a lower low. That is extremely bearish, noting that there was no acceptance over the top of a red-bodied bar like that, and we should be expecting lower here out of our XLC. Next up is the XLI. What's going on with industrials? Clearly making the rotation through this thin structure. I would be looking for 101 when and if we get to 101 and there's a reprieve bounce. Maybe if that aligns nicely with a counter trend move for the S&P as a whole, we would pay attention, but for the most part, not helpful to the bull side. XLF, what's going on with financials? Big test. This is do or die, right? The weekly time frame chart needed to produce, remember this, as a weekly higher low. Obviously, coming into it after a weekly lower high sets up the same story basically as to what we just described over on the S&P weekly time frame chart, with a lower high coming into the neckline as a lower high double top. It gets really ugly underneath 33.65. So watching that quite closely. We are a little bit extended here in terms of distance traveled, too far, too fast. So a little bit of a snapback here. Maybe it keeps the broad market a bit more neutral early on in the week, and we can look for that counter trend move. But overall, any lower highs underneath 34.20, really ugly here for our broad market. Next up, we've got the energy sector pulling back, but still the opportunity for a higher low somewhere above 86.50. Remember that this has much more to do with inflation expectations. So energy, it's cooling off a little bit, but it's certainly not doing enough, or it's not seeing enough of a reversal to completely reverse the curse, so to speak, that oil inflation, CL inflation, is going to impact in our next CPI and PCE reading. So 50 SMA might be an interesting place. It's kind of in the midpoint of this chop, just keeping an eye for a potential higher low out of energy. As we know, this is a lighter weight sector. We don't want it leading any market reversals, so it's not helpful to the bull case if you're looking for a stronger daily reversal, right? As of right now, everything sector-wise is continuing to point to slightly more pain. XLB, really lightweight sector, but inside 3-bar play in the downward direction, breaching here really opens the door for this gap close. It's a lightweight sector, but obviously breaking to a new lower low as soon as this happened on Thursday, that's a big deal, right? Usually when we're just chopping around in a range in a lightweight sector, not too important, but when we break down and produce big weekly lower lows, bearish pressure across the board. Next up, real estate, same concept. Here it is in a sideways range. range, we were really not so much concerned about real estate in this range breaching to a new lower low, starting to become more bearish pressure. Is it too far too fast? Maybe. Even if we do get a counter trend move, it's counter trend and there's still all of this overhead supply weighing on markets for lower. XLY, this is where the most damage was done, and you can clearly see here you've got yourself your weekly double top, and technically speaking, we have closed underneath the neckline of that double top just by a slim margin. If we do see a counter trend move, looking for a reversal underneath, I would say underneath our gap here on the XLY, keeps this in ideal bearish consolidation because that would jeopardize this level breaking down again, right? Just no acceptance in the gap, really not much acceptance over that 163.25. As long as we're getting something that's this and lower, or even this and then sharply lower again, that sets up the bear case. If we do close the gap and then pull back for a higher low above, that might become interesting for a weekly look below and fail, but that would not be a primary bet based on the momentum and based on everything that we've discussed so far in our analysis. Here's the ratio grid. If you're not familiar with how to set this one up, check out the video tutorial in the top right-hand corner. For the most part, this tells a little bit of a counter story to our bearish narrative that's been taking place so far. And the reason I would say that is because if the broad market just made a big time lower low, why did the XLK ratio, in terms of a relative strength perspective, not also follow up with an equal low or a lower low? And I get it, it's certainly off of its most recent high here, but in the grand scheme of things, I'll show you yearly charts in just a second, this did not act the way I would have thought it would have acted on specifically the Thursday breakdown. So the XLK holding up here keeps me somewhat neutral and maybe optimistic for a counter trend rally only on our SPY daily time frame chart. XLV is starting to outperform a little bit. That is D for defensive. That is a risk-off indication. Look at XLF. This as well, right up to the equal highs, mild pullback, still an opportunity for a higher low. XLY, obviously the damage has been done here, but we're just sitting on the equal low. If we produced a lower low, obviously much more concerning for more protracted downside across the broad market. These, of course, we need to discuss as well. XLP creeping higher, not up and over the 50 SMA, but the XLU certainly is, and this would be much more of our red flag in the bottom left-hand corner. The other thing to point out here is the XLC. This is technically more of a risk-on sector as opposed to risk-off, and it remains pretty stable up here at these highs. If we show you the yearly look, it starts to become a little bit more clear. Apologize as that loads, but here we go. This as consolidation in an overall uptrend. Is it jeopardizing the lower low? No, and that's what we just discussed as we were a little bit more cropped in, right? XLV, still in an overall downtrend. It's certainly not threatening this as a double bottom breakout yet. XLF, big red flag. This continues to always be a red flag ever since the banking crisis breakdown, right? If we look at the XLY, I mean, yes, it's a sloppy uptrend and we're sitting right on the equal lows, so maybe this is more neutral than anything else, but in the higher time frame sense, it's not the end of the world here. Same thing with the XLC, continues to chug in the upward direction, and then down here, XLU is still a counter trend move in the existing context of a downtrend. So just a different way to look at our ratios here and maybe dial back on some of the overly bearish sentiment that we've provided thus far in today's analysis. If we take a look at the XLK over the XLU in relationship to one another, once again, you would have expected with this aggressive breakdown to the downside, a little bit more of a downside move here in the actual ratio. And it would just speak to the fact that, okay, as we've noted, the XLK was actually an outlier towards the top of the list with some of these more defensive sectors. So it leaves the door open for an equal low bounce and just sort of consolidation and not a full-blown bearish look in this particular ratio. Similar thing can be said over here in the XLY over the XLP, although this is a bit more exaggerated in my mind and to that extent would speak to, again, the resiliency or the possibility for a resilient move here out of the market. Noting that the XLP actually did okay in relationship, especially to the XLY. This ratio, sure, it did move lower this week, but did it take out and did it make a new lower low? The answer is just simply no. So I think that this dials back the bearishness maybe just a little bit. Overall, the structure break on the SPY still reigns supreme, but this is some supporting evidence in the opposite camp of things. Jumping on over to our good friend the dollar, you can clearly see high and tight consolidation over that 104.50 mark and pressing into the top of the overall range at 105.65. From a purely technical perspective, this is looking fairly ripe for a breakout, and obviously we know that a higher dollar would continue to put downward pressure on equities below. What does the gold contract have to say about this, confirming or denying over in the GCs? And this is really compressing more so than anything else. If we take out some trend lines, you could quickly sketch out something that does this. So we'll learn something when gold decides to break this wedge, but I would say the more price acceptance we get underneath 1950, the more it would support the case for the dollar to move higher out of the overall range. Similar comments over here on silver. In the grand scheme of things, this of course is a bearish pattern. We haven't broken down down yet. We're looking for a lower high, but if silver does need to repair, which is very likely based on the pattern and how these things typically unfold, this is almost too precise, right? It needs repair of that 2280 over in the silver contract, and once again, lower silver might imply that we get a higher dollar, putting downward pressure over here on equities. If these relationships start to change because there's some sort of fear that maybe these assets, hard metals, are seen as a safe haven asset, we'll note that when this breaks and equities continue to move in the downward direction. So we'll keep an eye on that relationship, but as of right now, I don't really think that that is the case. Let's take a look at the TNX 10-year interest rates. Massive breakout on the Thursday session. So you want to talk about why the market gapped down the way it did. I mean, there it is from the TNX perspective. And obviously, we've been talking about this from, again, a purely technical perspective. This was just ripe for a breakout, right? The chart pattern looked great. We had higher lows coming into this, equal highs, continued higher lows, even above the trend line. The break there makes total sense from a technical perspective, and throw in the added catalyst of what we learned from FOMC, and higher rates here make complete sense. So is it really adding up that the market's moving lower? Absolutely. So higher rates continue to put downward pressure on the tech sector. If we make that weekly lower low over in the XLK, based on this either coming in a little bit and producing a gap fill reversal off of 43.33, then I would say the market likely continues to move in the downward direction. What about the inverted ZT from a Fed tracker tool perspective? Let's try to get ahead of it, and then we'll look at the tracker tool. What you'll notice here is that we've consolidated and moved right back up to the equal highs. Remember that if we break this range, we're basically implying that, yes, we're expecting another hike into the end of this year. If we stay in here, it's much more neutral, and a breakdown would imply some sort of rate cut. Notice that we started to back off a little bit on the Thursday and Friday session, even as the TNX was breaking out big time in the upward direction. So it begs the question, did the Fed do enough expectation management in their press release on the Wednesday session, where they might have the back pocket of saying, no, rates actually broke out. We didn't need to raise them one more time. The market sort of took care of our job for us. We managed expectations properly. We're not going to hike again into the end of 2023. It's a possibility. Let's take a look at the tracker tool now. And just like that, no surprises, higher for longer out of the tracker tool, which is in total alignment with what we just talked about over on the inverted ZT. And I do think that the Fed did a great job of managing expectations and maybe had the market do their job for them without having to additionally raise rates into the end of this year. If we look at total probabilities, what you'll notice is that the market's actually pricing in the highest odds for an additional hike in the January timeframe of 2024, not in December or not in November of this year, which is quite interesting. But as we know, the largest issue that really came of the FOMC from Wednesday comes from our new updated SCP statement summary of economic projections. And the projection, the median forecast for the terminal Fed funds rate in 2024 went from 4.6 to 5.1. So the important part here is that we did actually have the interns do some math on these numbers for a projection in our S&P. Notice that this would have been a 100 basis point rate cut into 2024. Now we're basically forecasting about half of that, all right? And that's important. So about half of the expected cut is going to be the intention for 2024. And if we look at the earnings insight for our S&P, if we're looking at the forward 12-month, right, the earnings right now are being priced in at $240 per share. If we take a look at where the 1% cut from the Fed funds rate got us, it's from a low of basically 15 to a high, let's just use round numbers, at 20. So a 5-point move here in the PE ratio, under the impression that a 100 basis point rate cut was going to be coming in 2024. With now half of that as the expectation, we need to basically take off 2.5 points off of our PE, giving us a 17.5 PE, which is basically the blue dashed line right here, which is the 5-year average. 5-year average? Yes. No, sorry, 10-year average. You can see. Thank you, FactSet. So coming back to the 10-year average in a PE, 17.5 multiplied by $240 per share from an earnings perspective gives us 4,200 in the S&P. And lo and behold, does that not align beautifully with what we just discussed from a technical perspective, finding monthly higher low support at 420 roughly in the SPY. And you could even do this if you take a look at the trailing 12 month, if you want to use the historic data, right? So $200 in terms of earnings. The move from here to here was 6 points. If you take 3 off of it, it gives us basically 24 minus 21 PE at 200 EPS. There you go. You still get your 4,200 out of an S&P for a projected target. So thanks to the interns out back, they did a lovely job on the modeling here based on the new projections from our SEP. If we look at the calendar for the coming week's worth of trade, what do we have to look out for? It's primarily going to be the GDP numbers, unemployment claims, and then Powell speaking on Thursday, right as the bell closes, will lead to some fireworks for Friday into the open, because you need to pair that, of course, with our core PCE, the Fed's favorite measure of inflation. How about the risk appetite of the market as this breakdown has been taking place? Notice that the TLT ratio to the S&P is not at the resistance trendline. However, it is flattening out, and it is worth noting that there is some outperformance from the TLT if we zoom in on the micro sense. This is certainly outperforming this over on our S&P, so a small flight to safety may start to take place here, but we have not broken the major trend line yet. Let's take a look at short-dated bonds in relationship to one another, because this clearly tells the story that yes, there is some concerns about the longer end of the curve, with the shorter end becoming the more favored outcome, right? That just basically speaks to less appetite for risk as a whole in the financial system. If we take a look at credit spreads, this is doing something incredibly interesting in my eyes, and it kind of aligns with short-term risk, but not long-term risk. This credit spread down below, the SHY versus the HYG, is the shorter of the two durations. LQDIEF is much more so 3 to 7. This is 1 to 3 right down below. So the longer term credit spread is actually tightening, doing what we want to see happen from a risk perspective, and this is doing the opposite. So the market is basically seeing in the short term some issues, but in the longer sense, not necessarily all that bad. This continues to drift in the right direction. So does it speak to short-term pain? I would argue yes, based on the lower of these two ratios. What about HYG in isolation? This is another chart that we're going to have to zoom out on, very similar to what we just did over on our ratios from the sector perspective. If we go to a yearly time frame chart, this speaks to the repricing of 4,200. There's 4,200. Notice that the HYG, right, just on a relative basis, if this marks off this similar high, you went on all of this additional run in equities, and the HYG basically participated in none of it, right? No breakout in here, no higher highs being produced. So in the short term, we've been paying attention to these little micro divergences, right? But in the longer run of things, this would totally, sort of speak to being okay having the S&P come back down towards that 4,200, which we also calculated from a fundamental valuation perspective. So far, everything's kind of making sense for an S&P that gets much closer towards our 4,200, 420 over on the SPY itself. What about Bitcoin? Just to take a look at the digital gold inverted hammer on last week's session, suggesting that if we do break down there, it's nothing more than a big time lower high, opens the door through this thin structure, once again, furthering the downside pressure or just lack of risk appetite in financial markets until we get closer to 2150, 21.5. What about market breadth? You would expect it to be deteriorating as the market is pulling back, and it absolutely is. We're underneath the zero line, making a new lower low in new highs versus lows for our NYSE as an entire exchange. Let's take a look at the SPX A200R making a new impression underneath the 50% mark. And what about our SPX A50R stocks trading above or below their 50 SMA? Clearly a new lower low as well. So no major divergences. And once again, as the market's breaking down, this is making sense that breadth is moving in the downward direction. Same story if we take a look at the RSP equal weight S&P 500. Notice that we are underneath this point. That would be the equivalent, basically looking left, right? It's basically suggesting that we get to 4,200 and some over an equal weight S&P over here. So watching to see if we can catch ourselves for 140 support out of the RSP and just consolidate in here as the weighted S&P plays, quote, catch up and moves down towards that 4,200 target that we've been referring to thus far. Last but certainly not least, from a breadth perspective, is the Dow transports versus industrials. This is starting to feel, of course, like it's breaking down. It's failed this trend line a number of times. It did technically produce a lower low, but it's just so clear that it's still divergent. This has room to run in the downward direction over in industrials, which would spell more downside potentially for broad markets as a whole. What about volatility? VIX finally breaching up and over the 15 handle. Something that we talked about on the Wednesday update was that, hey, because we're underneath, it technically leaves the door open for a move in the upward direction, and that certainly did come true up and over, again, that 15 handle. So we're certainly not in capitulation zone, and an elevated VIX in here would speak to more fear and just basically uncertainty down below in equities, which certainly makes it easier for people to sell off into instead of buying into a new budding uptrend. Not that we have an uptrend by any stretch of the imagination, as we discussed on the SPY Daily. What about the VVIX, the volatility of the volatility index? This is not even up and over. It's a 103 handle, and as we know, the 103 handle, taking that out, is the precursor to a capitulation type bottom bottom in the VIX itself. So still some room to run in volatility for a move in the upward direction, which of course would imply an easier time selling off in broad markets as a whole. Just expect expanded ranges, right? Here's VIX futures, volatility futures. Notice that we're not quite all the way in a backwardation reaching that zero line, but pretty darn close over the last couple of trading days to invert volatility here. So it's not technically there yet. It would be, inappropriate to call it a backwardation. We're still technically in contango, but strong strides towards that zero line once again start to make money managers a little bit more concerned, right? As the spread between this, and let's just say that it used to be like this, as that narrows and there's only a little bit more volatility in the future instead of the inverse, right? Money managers are just less likely to allocate capital in the short term, which makes total sense as this market is breaking down. It's like, hey, let's take it easy here and see if we ultimately hit that 4,200. And then if volatility subsides, can we find market structure off of the monthly high or low? 9 versus 30-day VIX did in fact invert, so this is over the zero line. That is technically in backwardation, and you can just see sustained volatility over in the 1 day. So jumping on over to the QQQ weekly time frame chart, what do we see here from a candle structure and location point of view? Structure certainly bearish, very similar to our S&P, solid red-bodied bar, minimal upper wick, strong close on the lows from our sellers, and in terms of location, bar to bar lower high and a substantial lower low, breaking down from the double inside bar closing underneath the container bar, but not closing underneath our last higher low in the overall trend sequence. So we are not definitively in a weekly downtrend over here on the QQQ until we break down through the neckline of this double top, which as we know is much closer to 355, give or take. We've closed right on it, don't get me wrong. Coming into it after a lower high would suggest that any tests of this level should open up the door for lower. And what would the lower target be? Just like we did on the S&P, our downside target is way underneath us in the QQQ through all of the thin structure retracing the AI mania breakout as a whole. Your weekly 50 SMA will meet you there, and again, that's about 40 points of downside activity roughly. We're just eyeballing here on the weekly time frame chart if that substantial breakdown does take place. Is there anything to stop us in between? Let's take a look at the anchored view apps here from a weekly perspective. So AI mania anchored view app has been slashed and closed underneath. If you look at the anchored view app from back here, the origin of this entire rally, that is hanging out somewhere around 350. 350 is also important from a Fibonacci perspective. If we come in from the all-time high to the October low, and we come in from the low of here up to here, it's that same confluence level that we were just discussing over on our SPY at 430. It's the same thing here on the QQQ, but at 350, right? So confluence with your anchored view app and Fibonacci's. If the market does continue to extend lower, I'd be thinking that maybe there's the opportunity for a counter trend rally off of that, in the context that of course would imply first to get there, you've broken your equal low and you've produced a lower low, confirming a weekly downtrend in the QQQ. So we're almost there, but not there yet. So be open-minded to the possibility that if this holds and we do see a counter trend move, it's really more neutral in the QQQ than anything else. And coming back up into the midpoint, the breaking point, so to speak, of this range is more so an area to be patient as opposed to anything else. Remember that in a balance range, you never really have an edge in the midpoint. I suppose that you could look for another weekly lower high on the back test there, very similar to our S&P, but it wouldn't be nearly as powerful, not coming from a new weekly lower low. What does the volume profile have to say about all of this? Let's take a look. And what we'll notice is that the high volume node, of course, has been broken down from. Let's zoom in a little bit on that, shall we? So we've broken down from this high volume node, and we're in a low volume void, whereas the next high volume node, the major one underneath at least, is around 320. There's not much of a saving grace at that Fibonacci and anchored view app perspective around 350. So this would totally support the thesis from a volume perspective that, yeah, 320 is a valid downside target. Let's move on down to a daily time frame chart. We'll do it this way today over in the QQQ. Let's zoom in and let's briefly discuss our weekly expected move here. What do we see from that perspective? Certainly bearish, obviously suggesting some sort of big time lower high. The number is 367. Let's just round off there, 367 on the top side, and the bottom side, 349 even. Right, so a big time lower high or a big time lower low. If we do get to the lower bound of this week's expected move, obviously that would be a breakdown of your weekly equal low, and it would usher in a weekly downtrend. This is interesting because, again, if this is basically a 2-bar range, we did reject and we did not attempt to close any of the gap on Friday's session. So if we do start to close that gap, I would still be looking for the same concept as what we discussed in the S&P, with a lower high in the daily being set around 364.75. Very similar comments in terms of pattern and overall structure here. Again, weekly opportunity for a lower high here. We did not make a lower low, but daily is certainly in a downtrend with highs, lower highs, lows, lower lows, and lower lows. You don't want to be a short on the lower low. However, after a 2-day balance is in place, it's fairly, I don't want to say easy. It's easy to identify, not easy to execute, but you can set up short setups up against 357.75 for a continued breakdown, which gets you to here, the weekly equal low at 355.25, right? That at least offers a little bit more of an edge from a posturing and positioning perspective, I should say. But ideally, we get a break of the 2-day balance range to the upside. Lower high is set. Ideally, the lower high is anywhere underneath your daily double top neckline at 370. The only time that the bulls really build a stronger edge is on something that would look like this. And does that seem like a probable situation into the coming week's worth of trade? As of right now, the answer is certainly no. Let's take a look at our trend lines and see what these can tell us. Very similar to the S&P in the sense that the lower bound is the expectation in here if we do continue lower on a breakdown of your major trend line, right? So your major trend channel from the October low, there's your anchor to set it up, right? We've clearly broken your secondary trend line. We did that long time ago, right? This is a back test technically for your weekly lower high. But now on the breakdown of this, right, the first target is the horizontal level, and then the bottom of your red counter trend channel on the higher time frame for something, again, maybe like a monthly bull flag, something that looks like this starts to become a target. So let's throw back on our set like that and just point out what some of those levels are underneath 355.25. It gets pretty dangerous, right? Because this is that thin structure retracement. We have 352, lower bound of the expected move, 346.85, and that opens up single prints for the beginnings of the AI mania retracement, right? Thin structure. This thin structure has mostly been traded through as of right now, but that's the threat underneath, right? That is the threat underneath, and there is your 320. A lot of it, it's a stretch. We're not talking about this into the coming weeks worth of trade, but just trying to illustrate kind of what the dangers are here if we do ultimately flip into our weekly downtrend. Again, we don't want to jump the gun. We need to be underneath this level, but just giving you the numbers underneath. Let's take a look at the Anchored View App fan as well over here on the QQQ and just point out the similar concept where we have two cohorts. This is everybody who got involved ahead of the AI mania, and this is everybody after the AI mania. All of the after buyers are potentially confluence of resistance on the backtest for a lower high weekly up against that 370. We just discussed that, right? And then if we do continue lower, as we pointed out, this would sort of be closer to the bottom of that red trend channel, closer to 346.85. And that is really your last line in the sand, this Anchored View App, before we get not only into the Anchored View App band, but start to, again, retrace some of this extremely thin structure off to the left. I don't want to be a fearmonger here, I'm just talking about the structural deficiencies that are technically underneath us. Once again, please be patient and wait for a confirmed weekly downtrend before trying to execute on any of those ideas. And even if we do rally, looking for a lower high here or looking for a lower high here. If we drop it down to the hourly time frame chart, there's not much to really update on over here. Similar concepts to our S&P where on Wednesday we got a gap up. There was no gap fill reversal on the initial hold from Wednesday morning before the FOMC breakdown, so a little bit weaker from that perspective. Thursday, no attempt to close the gap overhead. And Friday is more impressive to the bear side because technically you can see that we did spend time over the spike, which is down here. Again, let me zoom in on that so we're not looking at something off in the very bottom of the screen. Let's zoom in. There we go. So we technically open and get a rally up and over the spike, but there's no attempt to close the gap, and we fail at that exact level right here, 360 in the QQQ into the afternoon. So I would say that the buyers had their shot on a strong internal showing on the open. We'll see that in just a second. To squeeze some of the shorts out, it just never took place. So number one, it would mean that the buyers are just simply weak, and that number two, the sellers are really strong, right? So it doesn't really matter how you slice the cake there. That is more of a bearish than bullish indication. Here are the NASDAQ internals. And again, strong outflows on Thursday. They flip bearish on Friday, even after opening in the positive direction, decently positive on Friday. Obviously, full-blown correlation on Thursday. Nasty, nasty, nasty. Friday, I would argue, builds out more bearish in the QQQ as opposed to the nicey side of things. But once again, on Friday's open, we're opening around positive 750 or something of that nature, right? Positive 750 gives the buyers an opportunity to squeeze up and over in here, and it didn't really have legs. It didn't really go that far. We didn't interact with the gap overhead, and instead, we know the rest is history, and the sellers kind of run away with it into the close there. Let's take a look at the SMH. There's been a lot of comments about semis recently, so let's do that together here. SMH is an internal, so to speak, for our NASDAQ. Let's throw on just our 50 and 200. And what we'll notice over here is that the semis have already broken down from what looks to be a rounding top. You could call it sort of, we've been calling this the Man Ray pattern, right? So shout out to Man Ray, head and shoulders, Man Ray pattern, whatever you want to call it. Clear rejection there underneath on the Friday session. Thin structure to break down through. I mean, you're talking about 143.40 down to 134 on your daily 200 SMA. That, of course, puts downward pressure across the entire market, noting that semis are kind of the backbone of tech in the first place, right? So watching that quite closely over in the SMH. If you're not a fan of the SMH, you could look at something like the SOX, and this is doing the same thing. There is your overhead supply breaking down from it, rejections on Friday's session with the inverted hammer, right? So boom, there it is. There you're kind of looking for lower thin structure retracement back down to this area here and your daily 200 SMA. What do I have for you from a market profile perspective over on the NASDAQ? Inside, well, maybe not inside, but back-to-back balance ranges. Remember that we were saying on the S&P that the value area and point of control was higher on both the Thursday and the Friday session. Notice that's not the case on Friday. Value actually does shift lower in the individual profile, as does the point of control, setting up, in my eyes, the breakdown of this very mechanical low for a move lower into the early stages of this coming week's worth of trades. So to short something, I would say that you probably don't want to be over on the nicey side of things. The NASDAQ, through the equal lows breaking from a two-day balance, looks a little bit more attractive here. And last but certainly not least for our broad market is the IWM Russell 2000 and the small caps. Just pure devastation over on this chart. Solid red-bodied bar, no upper wick, no lower wick, opening and closing dead on the extremes of the weekly range. From a bar-to-bar count, lower high and a substantial lower low. The reason it's substantial is because from a weekly head and shoulders perspective, kiss this thing goodbye. It's very likely that we're headed back down towards the bottom of the overall range. That would be this area right here, around 170. And as we've been talking about really over the past 2 or 3 weeks now, the small caps not participating in any of the upside rally that we saw over in the S&P and the QQQ, in hindsight, is starting to look a little bit like the canary in the coal mine. So nothing really constructive to say about your IWM weekly time frame chart other than the fact that it looks weak and it will continue to provide bearish pressure for the markets as a whole. We're underneath the entirety of our anchored VWAP cluster. The only saving grace, and we've talked about how this is actually a backhanded threat to some degree, is if we come from this high volume node and rotate down to the bottom, technically, yes, there is strong volume support down here, but what happens when and if we do something like this? Instead of strong volume support, now anybody who tried to long small caps at the bottom of this as an overall range is underwater, and that's massive outflows that you're going to experience from the Russell if we break down from this as a weekly balance range from a monthly bear flag perspective, weekly bear flag perspective. That would be fairly nasty. Now, again, I do not want to be a fearmonger. Obviously, we have a solid red-bodied bar, but we're still in the midpoint of that weekly range, right? We have not made it all the way back down to the bottom yet. We're not threatening a breakdown underneath like 165 roughly, so we're not there yet, but it's something to start thinking about. If the Russell is going to improve, it would need to recapture this area right here, which is much closer to 183. So speaking of 183, let's go to the daily time frame chart very quickly here. And we'll take a look at the Russell. No need to complicate things in the Russell, right? As long as we're underneath this, bears are in full control. Sure, we could trade for some counter trend rallies, and it would support the thesis that maybe the S&P and the NASDAQ also see a counter trend rally, but nothing changes about small caps until we either build out a new constructive uptrend, something that does this over time, so that's not going to happen this week, or if there's a massive market rally that does something that looks like this. Again, the market can always do whatever it wants to do, but I would prescribe certainly lower odds to that in the coming weeks worth of trade. Usually we're talking about 60-40. That would be like, 90-10. 90-10 odds for a higher low in continuation over 183 into the coming weeks worth of trade. If we do rotate lower, there's really not a lot of structure down here. I mean, we're talking about the full portion, the full deviation on the expected move with no structure, right? So there's nothing to save us underneath 176.25. The next support underneath is 172.50. Nothing on the hourly time frame chart really contradicts any of this analysis. Clear rejection on the backtest of this as an overhead range. That's your FOMC breakdown, gap and go, continued drift lower, no attempt to spike up and over and interact with that gap on Friday. So just everything about the Russell is fairly ugly here. Again, look at last week's expected move. Look at how far extended through it we are. Do you want to be a new money short on the lower low? Probably not. You're chasing it at this point in time, but there's nothing bullish about this chart here. If you do get a snapback, fine. You're not really looking to participate participate aggressively in that. You're rather looking to position with better risk reward for a downside continuation move out of small caps here. Let's take a look at the market internals for the Russell. Again, there's really nothing to write home about over here. It really supports the thesis that everything was bearish, 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 falling, making a move underneath the zero line. A little bit of improvements here on the advanced decline line out of Thursday's session, but nothing major. And notice that all of the cumulative ticks are substantially negative on the week in terms of Russell analysis here. So overall, small caps continue to be a drag for our broad market. If you've made it to this point in the show, I appreciate you tuning into the analysis. Drop a thumbs up, hit the subscribe button, all that good stuff, and let's get started with our core list of companies. Apple is up first on the chopping block. This is a daily time frame chart setting up a beautiful daily balance area over here on the right-hand side of your screen. If we can break through that after a weekly lower high, after a daily lower high, after sitting on our weekly equal lows here for quite some time, looking for a pretty substantial flush underneath 174. Typically, when we're dealing with balance ranges, we look for a double of the balance range. Notice that a double puts us inside of this gap range from our previous earnings cycle back here. It would seem to me that the threat would be a full gap close and some sort of interaction with our daily 200 SMA if this market is going to continue lower. Daily inverted hammers back-to-back on Thursday and Friday, gap fill reversals there. That does strike me as a more bearish data point. So how do we actually get involved in this? Anything that's consolidating here is bearish. Slips under 174, looking for lower highs here, target 172.25, and then continue to walk on down the targets you just saw from the daily perspective. The only time that you're going to be bullish on Apple is if we get a substantial retracement up here, higher low, and then attempt 180. I would not really be bullish just on a higher low over 177.85, noting that you're still stuck in a balance range, right? The only attempt is if we have a higher low and if we attempt to break to close this gap, that might improve things slightly. Let's take a look at Netflix. This continues to fall off of a cliff. It's been incredibly difficult to chase this thing in the downward direction. So I will stand by and again, stick to the analysis that it's tough to be a new money short dead on the lows here, even though it continues to drift lower. I'll stand by that. That's fine. If we can come into the daily 200 SMA, I mean, at some point, a counter trend rally will be set and we can reevaluate and hopefully look for something that's a little bit more tradable out of Netflix. On the daily chart, you can see you've got much more than a 100% retracement. If we go all the way here, it's kind of ripe for any sort of retracement here to set up a lower high on the daily around 390.25. If we take a look at the hourly time frame chart, the only thing that I can see, this is just total volatility on that Thursday session, right? Friday, it tries to go higher than it's like the only short trade I could see was the lower high here under 383, and that's into the last hour of the day. Definitely not my mojo here. So Netflix has been incredibly difficult to watch. That remains as a back burner sort of trade name. Here's Tesla. Strong breakdown on the Friday session from this as an overhead supply. Gap fill reversal on the Thursday session. Failure to hold the 50 SMA and right through the target. I mean, the target was 251. To close at the bottom of this prior range, very, very strong selling pressure over on Tesla. So what's the watch? Obviously on some sort of potential for a daily head and shoulders. Lower highs underneath your daily 50 SMA. Lower highs that are underneath anywhere below 260.65. Keep that dream alive. And we can look for downside from that perspective. If it just continues on this momentum, maybe an intraday lower high underneath 243 is enough to get involved on the short side, but just please make sure you have some sort of decent risk reward set up if you're going to participate in the stronger breakdown. You can participate in upside if you get some sort of daily hammer here, or hourly hammer, some sort of hourly double bottom trend reversal signal off of this area, something that does this, maybe you can trade for that upside rotation in the first place. My primary target would be where this breakdown came from at 255. I wouldn't pay too much mind anymore to 251 at this point in time. Next up is Google. What's going on with the Goog? Here it is on a daily time frame chart, just to illustrate that we are firmly back down now into our range number 2. Remember that range number 1 was ahead of our earnings announcement here. So inverted hammer on Friday, tried to get some acceptance over the daily 50, closes right at the low of the Thursday session, kind of in the midpoint of this range. I'm not necessarily convinced that you have an overall edge on Google here. I would prefer to see some sort of interaction with the gap close overhead and then positioning for shorts up against 133.65, target the equal lows in here. If we do just continue to drift lower, maybe intraday setups are offered underneath 130.35 for shorts, but I would prefer to see something that does this, some sort of attempt for support at the bottom of our previous range, right? Just because the risk reward profile of that trade is better, right? It's better to be a new money buyer into supports than a new money short after a sustained move in the downward direction into a new area of support, or old area of support, I should say. So Google, we'll leave it off at that on the daily time frame chart. Here's Meta on the daily time frame chart. I mean, play in this box at your own will. This continues to just be an absolutely wild mover. Here it is on the hourly time frame chart. In terms of trying to make sense of this, if this was going to set your lower high, then why was Friday up here? And then why did it reverse all the way back down to the low? So again, play at your own risk. These are the levels that I would use: 299.50, 303.85. Just a lot of volatility over in Meta right now. I suppose early on in the week, shorts are on the table with lower highs under that 299.50. If we're just chopping around in here, it's exactly that. It's chop, look left, and maybe, just maybe, we're constructive on a higher low over 303.85, but don't hold your breath, because look at what happened over here. Look at what happened over here. I mean, just a complete lack of follow through in every direction out of Meta. Very difficult trader over these past really couple of weeks in this entire box right on over here. Here's NVIDIA, still on an hourly time frame chart. Let's go back to a daily just to understand the context here a little bit further. Here's the overhead supply. This is the boulder that we're carrying up the hill. This is weighing down on us, making it very difficult to be a new money long. This is the unwinding of the AI mania trade. We're not all the way there yet, obviously, because we're not interacting with the first earnings cycle gap up, but man, we're getting pretty darn close, right? We're trading towards the bottom of this as an overall range, and this is a massive inflection point at 402.50. If we're above 402.50, then you can hang on to hope and you can be a little bit more neutral in this as a weekly consolidation range. If we're under that 402.50, I would tend to think that you need to kiss this thing goodbye, and it's very likely that we're going to come back down and interact with some of these lows over here. Let's take a look at the hourly to make a quick assessment. If this is going to be inverted head and shoulders, very simple for a counter trend move. Again, counter trend in the context of an existing daily downtrend, higher low over 419.25. Look to retrace the thin structure over here, thin structure over here. 432 sets up your better daily lower high for a new money short, right? Looking for something that does this. When we get there, short under the low and looking for continuation in the downward direction. You have stop, enter, and then target, somewhere near the equal lows. The risk reward profile is just far superior to the short side there on NVIDIA than chasing it down at the bottom. If you're just consolidating in this range, then sure, on a breakdown underneath 412.85, just again, please make sure you have some sort of indication for risk reward on an intraday time frame chart. Here's Microsoft on an hourly. Pretty tough on that Thursday, Friday interaction there. Again, lots of volatility in these tech names, not really respecting many of the levels that we've had outlined recently. So it's definitively more bearish the more time we spend underneath 326.75. But how do you want to get involved over here? Leaves a little bit to be desired. I would say lower highs underneath 319.75 are the primary outlook into the early stages of this coming week's worth of trade, setting up bearish rotations into 312.50. If we do want to flip to the bull side of the market here, we need to be up and over 320. And that is that. Let's take a look at Amazon, last but not least, the mini beast on a daily time frame chart. What do we see over here? Double back-to-back two-bar range, right? If we break down through that, we're looking for equal lows on the daily around 126.25. So looking for downside outcomes from a two-bar range breakdown out of Amazon. Not really thrilled about upside after the failure of this kind of reversal up here at the highs. It attempted some sort of cup and handle. Obviously we had this rounded bottom. It was playing nicely, exhibiting relative strength, made a higher high. No dice on the higher low pullback from that higher high. So definitively more bearish than bullish over on Amazon. If we take a look at the hourly time frame chart, what do we see over here? I think it's quite clear. Two-bar range is in play. Lower high underneath 129.15. Trade for 126.25. If we're chopping around in here, it's fairly neutral. Only interested in longs if we can start to interact with the gap over 132.25 closes at 135.25. And lastly, a couple of trade ideas for you. Thanks for coming out to the show. First up is Marvel. MRVL is the ticker here. Notice that the pre-existing daily downtrend is fairly strong, and we have on Thursday a bearish engulfing bar looking over Wednesday's high closing weak, extremely weak, underneath the lows, making a new lower low. Friday is an inside inverted hammer, setting up a 3-bar play in the downward direction. And if we can break Thursday's low at 51.80, we're looking for the rotation into our full gap close from the prior earnings cycle at 49.67. Our daily 200 SMA could also act as a target closer to 49 flat. If we take a look at the hourly time frame chart, how do we actually get involved? The trade setup is valid as long as we're in here. If we break down underneath 51.80, aggressive shorts can get involved on that. More patient shorts want the backtest lower high. Then you're looking to target this over time. So entry somewhere in this area, stop just above depending on where the structure is. So there's your entry. And you can clearly see that this is easily like a 3-to-1 risk reward in the downward direction. So watching that quite closely in the early stages of this coming week's worth of trade. And the last trade idea I have for you is ETSY, Etsy. What's going on with Etsy? This is a dangerous one. Here it is on the daily time frame chart, clearly in a pre-existing downtrend, consolidating weak on the lows, building out bear flag consolidation, descending triangle. Here it is on the hourly time frame chart, but we actually don't want to spend too much time on the hourly. We've got to actually go to the weekly. So here it is, right? There's your descending triangle. Bears on parade, flush point in place. If we break down underneath 63.42, produce a lower high underneath, we are trading trading for downside outcomes. But what is the ultimate target here? This is where the weekly chart comes into play. This one's fairly nasty. We actually have to open this up to max available. And looking left, I mean, there is not a lot of weekly structure underneath this low. It gets very dangerous all the way down towards 41 roughly coming from back here, and then our pre-sickness kind of lows right around that area, right? So not advocating for a full rotation of 41 in 1 week's worth of trade, just pointing out that Etsy does not have a lot underneath us potentially acting as support. There could be a thin structure retracement from when this really took off in the first place. That's all for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. Remember that we will be live at 8:15 tomorrow morning, Monday morning, just like we are every single Monday, Tuesday, Wednesday, Thursday, and Friday for our pre-market prep. Hope to see you there. And with that said, I wish you a green trading week.